Welcome back to the deep dive. It's the week of February 23rd, 2026. And looking at the stack of research we have today, it feels like two massive tectonic plates are just...
Slamming right into each other, yeah.
Right, exactly. You've got high-stakes politics on one side with that historic Supreme Court ruling, and on the other, the absolute Super Bowl of tech earnings.
It really is a fascinating collision. You have the machinery of government crashing right into the machinery of the market.
And our mission today is to help you navigate this because standing at this crossroads, well, it's a bit strange. On the surface, it looks like a party relief rally, but if you dig into these financial outlooks...
There's a lot of anxiety bubbling underneath.
Yeah. So let's start with the political earthquake. On February 20th, the Supreme Court hands down a ruling against President Trump's sweeping tariff implementation.
Right.
And looking at the charts, Wall Street absolutely loved it. I saw green across the board immediately after the news broke. It felt like the market let out a collective breath.
That is your classic relief rally in action. Markets generally hate trade barriers because they raise costs and, complicate supply chains. So seeing the courts strike them down was interpreted as a green light for global commerce.
But here is where it gets tricky. You would think a Supreme Court ruling would settle it. But looking at these analyst notes, the vibe isn't celebration, it's more like wary observation.
Because the fight isn't over. The analysis here suggests that market participants are bracing for the administration's next move.
Like what specifically?
Well, the White House could pivot to executive orders or apply legislative pressure to force those tariffs back in play. So while the stock tickers turned green, the structural uncertainty hasn't actually gone away.
Right. And I want to emphasize to you listening, we're just reporting what the financial analysts are predicting here, not endorsing any political stance. It's strictly about market reactions.
Exactly. It's more of a ceasefire than a peace treaty.
So we have a political ceasefire, but then comes Wednesday, February 25th. This is the event everyone has circled in red ink. Nvidia earnings.
The AI Super Bowl.
The numbers they're whispering are insane. For Q4 fiscal 2026, the market is looking for revenue confirmation near $65 billion.
Which is a mind-boggling bar to clear.
I mean, I remember when a billion-dollar quarter was a headline event. Now Nvidia needs to find that in the couch cushions just to keep the stock flat.
The bar is incredibly high. But if we connect this to the bigger picture, this isn't just about one chip maker. It is a referendum on the entire AI economy.
Because of the Magnificent Seven, right? Companies like Microsoft and Meta have been shoveling billions into the furnace of AI capex.
Precisely. Investors are basically saying, show us the fire or stop shoveling. If Nvidia doesn't show that these massive checks are clearing into actual enterprise-level revenue, the whole AI narrative might take a hit. They are losing patience with promises they want proof.
And the stakes for the broader market are huge. We are staring down that psychological S&P 500 level of 7,000. It feels like a beat or a miss here decides if we break that ceiling or crash into it.
It does. But here is the headache. Usually if everyone is piling into Nvidia and betting on S&P 7,000, they are dumping safety assets. It's a risk-on environment.
But looking at the commodities desk, they aren't dumping safety. Gold just shattered a massive milestone. It surged past $5,000 an ounce.
Historic territory.
Yeah.
And that is the contradiction. Gold is the bunker you hide in when the world is ending. Tech stocks are the party you go to when everything is great.
Right.
Right now, it looks like investors are partying in the bunker.
That $5,000 price tag has to be driven by fear, right?
It's a flight to safety. Despite the tariff relief, you have heating geopolitical rhetoric and that lingering fear of what the administration does next. Technical targets are even pointing toward 5,290. Smart money is hedging its bets.
And you see this split personality in the central banks, too. I was reading up on the Fed's nominee, Kevin Warsh. The outlook there is higher for longer. Rates holding steady at 3.5 to 3.75%.
Meanwhile, Europe is going the completely opposite direction. The ECB is looking at inflation dipping to 1.7%, so they are likely cutting rates. It is a messy macro picture with divergence everywhere.
But despite the mesting, money is moving. We are seeing a rotation trade into the S&P 493.
Which is Wall Street shorthand for the other 493 boring companies that aren't the massive tech giants.
Exactly. Money flowing into financials, healthcare, and mid-caps.
Which is actually a healthy sign. It suggests investors believe the economy is sturdy enough that growth can broaden out beyond just AI.
So to recap this wild week, the market is cheering the Supreme Court ruling and is desperate for Nvidia to validate billions in spending so the S&P can hit 7,000, and yet
gold is at 5,000, signaling deep anxiety.
We'll leave you with this thought to mull over. If the markets are rallying on the removal of tariffs, which is ostensibly a sign of stability, why is gold the ultimate fear gauge simultaneously hitting all-time highs?
A great question.
What does that contradiction tell you about the real state of the economy in 2026? Thanks for joining us on this deep dive.